Hi, Larry Gaines, PowerCycleTrading.com. In this video, I want to go through some trade management on a gold trade or GLD. So let's take a look and walk through this. So back on Thursday, on the 13th of May, right here, we set up a long trade on GLD, which is the gold ETF. So we were looking for a move here to the 200-day moving average. It could stall and then pull back, consolidate, and then we were looking for it to break higher. Now it did. It pushed up here to the 200-day. So we did an adjustment here, and then we did another adjustment, or we'll look to do adjustment here today, tomorrow, Friday. But I want to show you how this works. So what we can do is we can make these adjustments using options where we can increase our potential profit up to the upside and at the same time reducing our risk. So gold still looks pretty good here, and I've got a potential target up to 178, then to 182. Now another thing that looks good about gold, just to let me show you the kind of the correlations that it has to the dollar that helps it, and let's take a look at the dollar to gold. So this is a chart showing the dollar. Okay, so this is the dollar index, and so you can see that the dollar, when it goes lower, that makes global commodities cheaper because they're paying in dollars for things like gold, copper, crude oil. So here's your downtrend. You see it trending down. This is the dollar, and as that's trending down, you can see that gold is trending up. So if this has another big push down to the downside, that's going to pop gold even more. So we're trying to stay long gold, but we can do it with low risk by making adjustments using a calendar diagonal. So let me go through that with you. So we opened this trade, this long trade, on the 13th of May. Today's the 20th, and then on the 17th of May we did the first adjustment. So after the adjustment, what we did was we had to cover back our short call. So now we're long the 16 July. So we have lots of time in this trade. So we're long the 16 July 170 call at a cost of $5.15. So one option would be $515, and then when we did the adjustment here, we sold the 21 May. That's going to be for expiration tomorrow. The 177 call brought in 51 cents or $51. So we've got this spread, the spread on this being long the 170, short the 177, calendar diagonals, what it's called. Our cost is $464 per spread, and today it was up $263 going into the close per spread. So that's a 57% return. But we want to keep the trade open because we think it has potential to go to 178, maybe to 182. So what we're going to look to do tomorrow, if it closes below 177 tomorrow being the expiration date, this $51 we'll get to keep. Okay, so it'll expire worthless. That went out today about 21. But tomorrow, you can see here it's trading at 175.84. So if it trades below 177 tomorrow, this will just stay in our pocket. And what we'll do with that is amortize down, reduce the cost of this to 515 or 515, reduce that cost by 51. So our cost now basis will be $4.64 or $464, okay? And then we'll turn around and sell against it because we have negative theta right here. We'll turn around and sell next week, the 28 May, 178, probably the 178 call against it. It went out today at $69, bring in that credit. Now we'll have the spread on at a spread cost of $470, and then we will have potential if it goes out next week on the 28th. If it was to go out at our short strike at 178, this trade will be up over $496. So we can keep doing this over and over. If we think this is going to continue up, we'll just keep rolling it and amortizing down, just like a covered call. And sometimes this trade is called the poor man's covered call. So if you'd like to learn more about these types of option strategies, make sure to join me at PowerCycleTrading.com. Good luck trading.